What have the best fund managers done in the metal space to maintain a fantastic track record, and what strategies are they employing today? Joining me is Bob Thompson, Senior VP and Portfolio Manager over at Raymond James. Bob, welcome back to the show. It's been a long time. Pleasure to have you here today.
Great to see you again, David. It was about a year ago I was on, almost to the day.
It was, almost exactly 1 year ago. And I want to bring up that last year's interview because I think it's important. You had said a year ago that a bear market could be on the way and that 50% of market value could be wiped out. Now, we obviously saw what happened this year. Now, my question to you, Bob, is obviously nobody predicted the coronavirus, but do you think that a bear market could still have happened this year even if the pandemic had not occurred?
I think so, right? Because the Fed was pulling back before this happened, and this market rally has been totally fed by the Fed over time here. And I think the bubble was building, right? We have huge corporate debt here in Canada. We have massive consumer debt because of these low interest rates, and this is always how it happens. I think people are going to blame the coronavirus for this, but the coronavirus is just the pin that popped the bubble. The bubble was already there, and something always comes out of left field and pops the bubble when it happens. And if you look at every bear market in the past, it was building over time, and then something came along, like I said, out of left field, and then people blame it on that. But not necessarily. Is it all because of the coronavirus?
If it weren't for the coronavirus, what other factors could have been that pin? And are those factors still lurking underneath the economy here?
Well, I don't think so, because when the pin pops a bubble, it tends to expose everything, right? And as Warren Buffett says, you don't know who's swimming naked until the tide goes out. We're going to see a lot of naked people in the near future here, because we're going to see all this debt that is exposed in the economy. And obviously, what's going to happen is people are saying interest rates are very, very low right now, so no problem, people can continue to borrow. But the problem is you have to have access to credit. And if all the lending institutions who have been exposed now, and we saw that with the banks in the last few days, what's going to happen is they're going to tighten up the credit. And if they tighten up the credit, obviously the economy can't continue to expand. So it's kind of a self-fulfilling prophecy, and that's where we are right now.
We saw a credit crunch last time in 2008. Can this time be just as bad?
Yeah, a lot of people say this is worse than 2008. But the Fed has pumped in, 3 times or more of the liquidity that they did in 2008. But I think there's a real debate going on right now, and it'd be interesting to see what happens here. 2008 was kind of a liquidity crunch. Once they fixed the liquidity, then things started to get going again. This time, the liquidity event could turn into an insolvency event. Right? Unless they decide to bail out every company that's ready to go bankrupt, pay everybody's mortgage off in North America. I don't know. Who knows how far they're going to go? But this could turn into an insolvency problem. And obviously, pumping money into the economy doesn't solve an insolvency issue.
Now, the debt problem that you were just talking about, is that exclusive to the United States, or is that a global problem that you see?
It's a global problem, definitely. The consumer and the banking financial institutions were the 2008 kind of epicenter of the issue. This time it's not that. It's corporate America is highly, highly, highly indebted, because companies were simply, borrowing $1 billion at almost nothing and then taking the $1 billion, buying back their stock. So normally when you're going to borrow money, you're going to build roads and bridges or build factories for your company. But they were just doing financial engineering to pump up their earnings per share per quarter. And obviously, that didn't do a lot, but it's left them with a lot of debt now. Here in Canada, we actually have a consumer debt issue, and that's a whole other topic we can talk about. But that's more like 2007 back in the U.S.
Okay, we're going to talk about your portfolio allocation strategies towards the end of the interview now, Bob. But turning around the other side of the world, big news item coming in this week is that China has just today passed legislation that could approve a special security law in Hong Kong that many analysts say could remove Hong Kong's autonomy for good. How do you see this affecting global markets, and was this a surprise to you?
Yeah, I don't think it was a surprise. The timing, you never know when it's going to happen, but over 20 years ago when China took over Hong Kong, people have to realize China is a communist country. They used capitalism to their advantage, but really a communist country. So sooner or later, they were probably going to do this to Hong Kong. I think they've chosen this opportunity because things are in a bit of turmoil right now anyway. So obviously, it's going to be a big issue with regard relations going forward and trade relations. And I think the coronavirus is going to be played politically, so we can blame somebody, and China's going to be the one we blame, and obviously they're going to fire back, and it's not going to be good necessarily for trade.
So do you think this blame game could potentially escalate the trade war, like you said, but could it potentially escalate volatility in the markets, or is that just something that investors will shrug off?
Ordinarily, I would say definitely it would increase volatility in the markets, and the markets would not be a good place to be. But when the Fed, every time the S&P goes down, the Fed just prints another $1 trillion and pumps it in. I think the market figures that they have a backstop there. And, one of these times that won't work. But when you have people like Stanley Druckenmiller, probably one of the best money managers ever, that says he has never in his entire career seen a worse reward to risk ratio in the markets, and other managers, we have to take heart to that and say, this market is entirely liquidity driven.
So why are people still rushing in today? I mean, into the markets at this time? Is this just excessive exuberance, or is there something else at play?
I think it's excessive exuberance. It's FOMO now. There is a lot of money on the sidelines. FOMO stands for fear of missing out. There is a lot of money on the sidelines. People tend to think things are good because prices are going up. That's not necessarily always the case. And when you look at, the market pricing everything in for perfection here from this coronavirus recovery, I just think that's not a great risk reward trade. And I like to look at things that obviously are down, trading well off their highs. And that gives you generally a little bit of downside and lots of upside instead of the other way around.
All right, let's move on to mining stocks specifically. You have something called the mining clock, which viewers can learn more about at miningwealth.ca. Tell us a little bit about this mining clock, what it signifies, what it tells investors, and how we can read it.
Right. I didn't invent it, but I came across it a few years ago and kind of have enhanced it. And actually, a lot of our clients are mining executives, and I discussed this with these mining executives, and they hadn't heard of it before. So I think it's a great topic because it helps you to keep your eye on the ball as to where we are in the cycle. There is no cycle or no industry that is more volatile than the mining cycle. And I think so. It's really, really important to know where you are. So what the mining clock does is if you look at 12 o'clock, 1 o'clock, 2 o'clock, 3 o'clock, all the way around, it tells you what's happening at that point in the cycle. So in other words, you aren't paying attention to prices or what's happening in the stocks. You're paying attention to fundamentally where we are in the cycle, and then you know where we're going to go, and you know how far we have until the end of the cycle, for example. And people always ask me, if you think we're in a mining bull market, is it going to be how long? 3 years, 4 years before we come to the end of it? And I say, I don't know how long it could be. It could be 6 months. It could be 6 years. But I look at the mining clock, and that tells you exactly where we are at the time. So in other words, the market, what's happening internally in the market is telling us where we are, not necessarily the prices that we see. And right now, let's go back to the end of 2015. We were probably at 3 o'clock in the mining cycle. 3 o'clock is the point of maximum despondency. It's when companies are ready to go bankrupt. It's when companies cut their dividends. It's when they sell off their assets for 90% below what they paid for them just a few years before. We started to see that in 2015. Commodity prices are very low. Then we start to see in 2016 that commodity prices kind of stabilize, start to rise a little bit. Companies have got rid of the corporate jets and everything else that was weighing them down in the good years, and now they are starting to become cash flow positive. As they get cash flow positive, they say, wow, we don't have anything in our pipeline now. We've sold off a lot of our good assets at the bottom. So now they have to say, we have a depleting asset base here. We have to start buying other assets. So they start to take that positive cash flow and buy other companies, and M&A starts. And that's kind of where we are right now.
So given that you think stocks overall are probably overbought, how do you view valuations of mining stocks? Are we due for a pullback in that sector as well?
I think being a contrarian is really ingrained in me, and I don't like it when everybody's starting to talk about the mining stocks, right? And I'm starting to hear that now. Mutual fund companies, I'm getting 3 a week where they have interviews with their gold fund manager. And I always look at that and say, oh, that's usually a sign of kind of an overbought position in the short run. And in the midterm, in the longer term, I think we're at very, very, very cheap valuations in the mining sector. And if you look at any valuation parameter, the generalists are not invested in that sector. Valuations are extremely low for almost an all-time high in gold. If you look back the last time, gold was at 1,700, stocks were way, way higher. If you look at the GDXJ, for example, it reached 160 back in 2010, 2011. It's at 50 now, and prices are almost at all-time highs.
Speaking about investing, you've spoken to some of the best traders around the country. You've written a book called Stock Market Superstars that was published about 10 years ago. And in it, you've interviewed the likes of Eric Sprott, who is legendary in the mining space. Now, what has made somebody like Sprott done so well to beat his peers investing in the gold space? What strategies has he employed that you will look up to today?
Sure. The reason I wrote the book is I wanted to see, everybody has different investment philosophies, but only a few people stand out in the crowd. And I wanted to see what commonalities these people had. And as far as Eric was concerned, it was pretty interesting because everybody obviously knows him in the mining space. He's very active in financing companies, et cetera. But he wasn't always a mining guy, right? Eric was a great small cap stock picker, and his Sprott managed accounts averaged 25% a year over 25 years. And he didn't make it in gold stocks in the 80s and 90s. There wasn't a bull market at that particular time. So there was a few things that I learned there. And one of them, from Eric was conviction, right? You have to have conviction. You can't pay attention to what other people are saying. Right. You have to do your own research, and you have to have that conviction to stick it through. If you don't, then you're going to be selling when times are bad. And there's a saying, stock market corrections are when stocks are returned to their rightful owners. And I think that's a great strategy, because if you have conviction, you're going to stick with it. Back to Eric again, from a macro perspective, I said to him, how do you see things that other people don't? We saw the 2008 crisis coming. And he said, I read the same information as everybody. I'm just really good at connecting the dots. And I think that's important because we all have the same information. We just don't connect the dots properly.
Okay. Now, if you look at mining stocks in particular, about 10 years ago, you would argue that mining stocks then probably had an easier time accessing capital than they do now. Also, the prices of the underlying metals were different. So can the strategies that someone like Eric used back then, can they still be applicable today? And what specifically are those strategies?
I think so, and even more so today, because so many people have migrated into the ETFs, and the ETFs become riskier and riskier because the companies in the ETFs that have grown become the majority of the ETF. So I think we're really in a transition point where stock picking is going to be taking over from just passive investing into ETFs. So I don't think anything's changed, and I think actually even more so, outperformance in the near future is going to be able to be achieved by pretty smart people. And another thing that Eric said, which seems common sense, but people don't use it. He says, Bob, I like to buy a stock for $1 that I think in 3 years can make $1 per share. Pretty simple, right? But we're also focused on the short run here. If you can simply see buying an asset, and in the mining space, there's all kinds of opportunities available right now that you can buy a stock for $1 that you think in 3 years will be making $1 a share.
Now, Bob, you're a fund manager yourself. Tell us a little bit about your investing strategy. This year, for example, we've seen growth stocks outperform value stocks. So where do you find value? Do you look for value? Do you look for growth? How do you pick a stock?
Well, I generally have an overweight, obviously, in the metal space, because I think that's the most undervalued space around. I also have a value bent in the portfolios. I mean, there is some growth there, obviously, because you don't want to miss out on that. But I have a value bent and a lot of money in the mining stocks, because I think that's the place to be. Also, I manage money for mining executives, so obviously we're going to have a concentration in that area. But I think it's important to see where you are in the space. And I think at this time, where a lot of people mining stocks have had a nice run, they would normally rebalance. I don't think it's a good time to rebalance. I think stick with the mining stocks. We're going to have a good few years ahead of us, and the rest of the market's, not looking that great. sooner or later, these quant managers are actually going to look and say, they're going to run screens and say, which sectors here have the best earnings growth? Which sectors are making the most amount of money? And it's really interesting because the mining space, the gold stocks especially, have the best earnings growth, the best cash flows of any industry around there. The tech stocks are great. They've got great future sales and that sort of thing, but they don't make a lot of money. The mining stocks are actually swimming in cash flow right now.
So Bob, last question for you. As a fund manager, what are some of the biggest risks that you could see impacting your portfolio or anybody's portfolio? Like what keep you up at night?
Things getting worse with the coronavirus, obviously having a second wave come along. Mm-hmm. But I think like 2008, a lot of that liquidity crunch, hopefully we don't see that again. Our industry's run on something called VAR, which says you can take a lot of risk when volatility is low and you have to reduce your risk when volatility is high. Well, no wonder everything crashed in March. People were over-levered and then volatility picked up, so they all delevered at the same time. Hopefully we don't have to go through that again. And but I expect that, the market is overvalued right now, except for the mining stocks. And I would be worried if we had a kind of a second coronavirus outbreak and people looked and said, hey, wow, what the Fed has done here and printing all this money really hasn't helped the economy that much.
If you're constructive on the mining stocks, does that mean you're constructive on the underlying metals as well, gold and silver?
Definitely. And that's a great point because, usually money flies into the large cap gold stocks, and we've started to see that happen. But the people that are selling those stocks redeploy their money into the mid caps and then the small caps after that. So that's what I'm doing, is looking at the mid caps and the small caps, the exploration stories on the gold and silver side, but also, my own portfolio. And for clients, I'm really getting interested in the silver stocks because I think that's a when, not an if question. And I think, even if it's a year or two out on silver, and we get a spike in silver, the optionality these companies have is incredible. Let me just give you one example, 10-second example here.
Please.
If you, let's say on the silver side, if your cost of production is $10 an ounce and silver is $11 an ounce, you're making $1 an ounce, obviously. Now, if silver goes to $12 an ounce, that's only approximately a 9% increase in the price of silver, but you're now making $2 an ounce because your cost is 10 and you're selling it at 12. So your profits went up 100% when the price of silver only went up 9%. And that sort of leverage is incredible. And that's why you saw in 2016, the silver price went up by 50%, and a lot of the silver stocks went up by 500%. And that optionality, or that taking a bet on the higher price of silver can really reward you. And, that's the things that I'm looking at right now.
Okay. Well, thanks very much, Bob, for being on the show today. Great insights.
All right. Fantastic. Thanks again, David.
And thank you for watching Kitco News. We'll have more for you, so stay tuned.